wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 183, and in this episode we are reviewing the performance of the financial markets during the 43rd week of 2025, and that is from Monday the 20th to Friday the 24th of October. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the Consumer Price Index is the only official economic data that is allowed to be released during the government shutdown, and the reason being that the CPI data is used as a benchmark for making cost of living adjustments to Social Security benefits like retirement and disability allowances. The CPI data was released on Friday by the Bureau of Labor Statistics, and it showed that prices that consumers paid for a variety of goods and services rose less than expected in the month of September, which keeps the door open for another rate cut by the Fed this coming week. The Consumer Price Index showed the annual rate of inflation at 3% in September, which was a slight increase from the 2.9% reported in August, but was a tad bit lower than the Dow Jones estimate of 3.1%. However, excluding food and energy prices, the core consumer price index also showed a similar annual increase of 3%. The markets are pricing in a near certainty that the Federal Reserve will lower its benchmark lending rate by a 0.25 percentage point during its next policy meeting this coming week, and as traders are also expecting another rate cut in December. Over to the United Kingdom, where the latest data from the UK shows that inflation came out cooler than expected in the month of September, pointing to another interest rate cut from the Bank of England before the end of this year. The data that was released by the Office for National Statistics on Wednesday showed that the annual rate of inflation remained unchanged for the third month in a row at 3.8% in September. This is compared to a Reuters poll that had forecast inflation at 4%, but even at 3.8%, this indicates that financial pressure still remains high for both consumers and businesses. Meanwhile, core inflation, which excludes volatile food and energy prices, this rose at an annual rate of 3.5% in the 12 months to September, which was a dip from 3.6% in August. Earlier this year, the Bank of England had forecast that the Consumer Price Index would top out at 4% in September before gradually cooling off into next year. Economists project that the central bank will maintain its cautious stance given that inflation remains sticky and the outlook for economic growth is lackluster at best. The Bank of England's next monetary policy meeting is scheduled to take place on Thursday, the 6th of November, and with inflation running at almost double the central bank's target rate of 2%, it is highly unlikely that the committee will implement another rate cut this time around. Over to the Far East, where Japan's core rate of inflation accelerated to 2.9% in September, up from 2.7% in August, and actually came out in line with market expectations. Meanwhile, the all-inclusive headline rate of inflation, this also increased from 2.7% in August up to 2.9% in September, but still remains above the Bank of Japan's inflation target rate of 2%. Whilst the core inflation data in Japan strips out only the prices of fresh food, the so-called core inflation strips out both fresh food and energy costs and is the rate that is closely monitored by the Bank of Japan, and this rate eased off from 3.3% in August down to 3% flat in September. And in related news, Japan's new Prime Minister, Sanae Takaichi, pledged on Friday to accelerate a defense spending target by 2 years as her government pursues proactive fiscal expansion on strategic priorities. Takaichi, who is an advocate of expansionary fiscal and monetary policy, has vowed to maintain market confidence and achieve sustainable public finances by reducing the government's debt to GDP ratio, which currently stands at about 216%, making it the highest amongst developed economies. On Wall Street this past week, U.S. stocks closed at new record highs on Friday as cooler inflation data reinforced the view that the Federal Reserve will continue to cut interest rates, and this in turn will boost the U.S. economy and justify the higher valuation for equities. Following the release of the inflation data, traders increased their bets that the Federal Reserve will cut interest rates at both of its remaining policy meetings this year. All the three major averages gained by about 2% this past week and closed at record highs on Friday as the Dow Jones Industrial Average rose by 472 points to break above 47,000 for the first time ever as it settled at 47,207. Meanwhile, the S&P 500 ended the week at 6,791, whilst the tech-heavy Nasdaq Composite came to a close at 23,204. In the government bond market, the yield on the 10-year Treasury bond hovered around 4% on Friday as investors assessed the much-awaited inflation report for the month of September, which came out cooler than expected. September's inflation data was delayed by about 3 weeks due to the ongoing government shutdown that entered its 24th day on Friday. This latest inflation report has raised the likelihood that the Federal Reserve will continue to cut interest rates at its 2 remaining policy meetings this year. According to the CME's FedWatch tool, interest rate futures are indicating that the Fed will almost certainly lower rates when it convenes this coming week and has also raised the probability of a December rate cut to about 98.5%. In response, the yield on the 2-year Treasury note was a little changed at 3.48%, whilst the yield on the benchmark 10-year Treasury bond was up by 1 basis point at 3.99%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil edged up on Friday and was on track for a weekly gain as fresh U.S. sanctions against Russia sparked concerns about the supply side. On Thursday, President Trump announced fresh sanctions against the two biggest oil companies in Russia in order to pressure President Vladimir Putin to end the war in Ukraine. Oil futures have been driven lower in recent weeks on expectations of a supply glut as OPEC and its allies increase production with a view to regaining market share. On the other hand, the 6-month spread for crude oil futures has returned to backwardation, which describes a market structure in which the future price of crude oil is valued at a lower level than the current price of crude oil. Backwardation is usually an indicator of undersupply in the future, which explains why traders are willing to purchase oil for a higher price today rather than wait for a lower price in the future. Following the sanctions announcement on Thursday, both benchmarks jumped by more than 5% and were on track for a weekly gain of about 7%. With the price of the global benchmark, Brent crude, coming to a close at $65.91, whilst the U.S. benchmark, West Texas Intermediate, settled at $61.47 per barrel. In the precious metals market, the price of gold recovered partially on Friday after a slightly softer than expected U.S. inflation report reinforced expectations that the Federal Reserve would cut interest rates this coming week. However, despite the recovery, the price of gold was still on track for its first weekly loss in the past 10 weeks. The price of bullion declined by more than 3% during the week as investors booked profits and as signs of easing trade tensions between the US and China dented the safe haven demand for gold. On the flip side, the annual rate of inflation in September came out softer than expected, prompting traders to fully price in a 25 basis point rate cut by the Federal Reserve at its next policy meeting this coming week. The prospect of lower interest rates has reduced the opportunity cost of holding gold, which is a non-yielding asset, and this is what caused the price of gold to spike up on Friday. The price of spot gold has risen about 55% so far this year, but was still down by more than 3% during this past week as it eventually came to a close at $4,101 per ounce. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. We now change scene to the Kenyan financial markets. And we start by looking at the domestic foreign exchange market, where the Kenya shilling continued to mark time versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at the same rate of 129.24. Meanwhile, the sterling pound was priced at 172.23. and the euro was valued at 149.76. And on the regional front, one Kenya shilling was changing hands for 26.97 Ugandan shillings and 19.36 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.24. Despite the Central Bank of Kenya operating a floating exchange rate policy, the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves remained relatively stable with a grand total of $12.08 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. This increase in Forex reserves was attributed to a recent issuance of a new Eurobond for $1.5 billion that was used to refinance the early buyback of the $1 billion Eurobond, which matures in 2028. Despite this massive increase in reserves, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was relatively stable at 9.26%, which remains in line with the central bank rate at 9.25%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 7.8 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 23rd of October, and the central bank received bids totaling to 25.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 105%. The central bank ended up accepting 25.3 billion shillings, and the results of the auction were as follows. The 91-day rate declined by 3 basis points to settle at 7.82%, whilst the 182-day rate dropped by 4 basis points to close at 7.86%, and the 364-day rate dipped by about 2 basis points to average out at 9.34%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the November bond issue, in which it is looking to raise a total of 40 billion shillings through the sale of 2 reopened fixed coupon treasury bonds, whose terms and conditions are as follows. The first bond is a 20-year bond that was initially issued in 2012 and now has 7 years left to maturity. This bond has a coupon rate at 12% flat. The second bond is a 15-year bond initially issued in 2022 and now has 11.4 years left to maturity. This bond has a coupon rate at 13.94%. These bonds are now open for sale until Wednesday, the 5th of November, when the auction will be held. Staying in the bond market, the Central Bank of Kenya is looking to execute a bond buyback during the month of November, and the bond in question is FXD1/2023/003. This is a 3-year bond that was initially issued in 2023 and matures on the 11th of March 2026, which means it has about 7 months left to maturity, and the total outstanding amount on this bond is about 76.5 billion shillings, but the central bank is only looking to buy back 30 billion shillings. This buyback is open to investors with unencumbered holdings in this particular bond, and participation in the auction is on a voluntary basis, and investors may opt to sell back either part or the entire holding that they have in this bond. The offer for the buyback is now open until Monday, the 17th of November, when the auction will be held. Up next is our topical issue, and this week we're looking at the IMF's call for transparency and the issue of the sovereign bank nexus. The International Monetary Fund has urged transparency as Kenya deploys a wider mix of financial instruments in order to expand its borrowing options amid rising debt pressure. Abebe Selassie, who is the IMF director for the African department, said that though it was common for countries to try and generate more resources through innovative schemes such as public-private partnerships, such efforts must be open to public scrutiny. The director was addressing a media briefing on the sidelines of the IMF annual meetings in Washington, when he said that what was fundamentally important was ensuring a full assessment of all the implications that may arise from a wider mix of borrowing instruments, including subjecting the process to both public and parliamentary scrutiny. In its 2025-2026 annual borrowing plan, the Treasury said that it would prioritize the use of non-market-based measures in order to better manage its external debt. Some of the debt instruments under consideration include the issuance of a samurai bond from Japan, as well as bond buybacks, which is already happening with Eurobonds, and the use of debt swaps to restructure existing obligations, which happened recently when the Treasury swapped a $3.5 billion facility into Chinese yuan in order to benefit from lower interest rates and reduce the debt repayment burden on Kenyan taxpayers. The director also discussed the issue of the sovereign bank nexus, which refers to the close connection between a country's government and its domestic banking system. The IMF is particularly focused on this issue with regards to emerging markets and developing economies where commercial bank exposure to sovereign debt has risen rapidly, especially since the COVID-19 pandemic. The IMF has raised concern that as access to external funding becomes increasingly tight, commercial banks in developing economies may end up taking up too much government debt, and as distress levels continue to rise, it could expose commercial banks to significant sovereign risk, which in turn informs the IMF push for recapitalization of banks in emerging and developing markets. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they can also make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the pessimist sees difficulty in every opportunity, and the optimist sees opportunity in every difficulty. A quote by Winston Churchill. Think about it. Thank you, and God bless.